I'm going to kick things off. Thanks everyone for joining us. This is the Exit Advisors Weekly Town Hall Series. Man, we've been doing this since, I guess, early March when COVID first started and haven't missed one since. So got a really good index of material for everybody. Check out our website, check out the resource page. Today, we've got a really interesting topic, and we've got Joe Ward and my actual college roommate, Zach Schultz. He was roommates with me at Clemson for at least a semester, I think. Or was it a whole year? I forget, Zach.
It was a semester, yeah.
Semester, and good old Clemson. But they're gonna be going over a really interesting topic, and as we were kind of discussing before this, a lot of these topics could be presentations within their own, with what they're going to be talking about today. But the idea, the general gist here is how a business can raise usually a minority amount of capital, but raise capital to grow and build their business, but still maintain control of it. There's a lot of dilution and things that can play in here, and it's really important that you have an M&A attorney that are experienced in this field like Zach and Joe are. So I'm really excited to hear what they're talking about. I looked through their presentation. They've got a lot of really interesting slides that we're going to discuss. And I think they want to make this dynamic. So as we're going through it, if you have questions, use the hand raising feature, use the Q&A. If we can, we'll unmute your mic, get you involved. And if not, we'll save it for the end. But the quick little overview about Exit Advisors, we are the deal team. We're the M&A side or the advisory side of the transaction. And I've, a few of the times we've had these presentations, I talk a lot about the deal team and the importance of bringing kind of the real heavy hitters in, and you've got groups like Miles and Stockbridge, Zach and Joe that are on the legal side. You've got the advisor that's going to run the transaction, and then I've also spoken to how much we do, before the transaction, the pre-due diligence, getting businesses ready, helping them maximize their value and really streamline the process. And then you've got, your IT, your ops people that we bring in. So we really like to hand select and hand pick a very tailored deal team to really get these transactions across the finish line with the most amount of value and the least amount of headaches. So I'm going to go ahead and pass it over to Zach, who's going to introduce this a little more. But thank you all for joining.
Great. Good afternoon, everyone. Want to first thank Exit Advisors, Gary, Al, Casey, Andrew, Maria for inviting us to talk on this topic. As Andrew mentioned, we were roommates in college in the same fraternity, and it's pretty remarkable to see how we've gone from where we are to where we were to where we are now. So, again, just really excited to be here and talk about this topic with you all. When Andrew and I first started discussing, the notion of coming and participating in one of these town hall series, I think I started thinking about, what are some interesting things that we're seeing on our side. So we are a full service law firm. We within our corporate sphere, we help businesses in their full life cycle from conception all the way through an exit and everything in between. So started thinking about some of the things that we're seeing that is maybe a little bit different. And one of the areas that we've seen a really robust uptick is this notion of private equity investment or other growth capital in a minority position. I think a lot of folks are familiar with, and Joe's going to touch on this a little bit more, but I think folks are very well versed in traditional notions of venture capital and private equity and the boundaries that exist there. But what we're seeing is really the tearing down of those boundaries and seeing investors take on very sort of morphed or hybrid models and how they're coming in and helping companies. And what we're finding is, this area of growth capital stage, where we're seeing some of the most activity in this space. So with that, I'm gonna turn it over to my colleague Joe Ward, who's gonna kick off the beginning of this presentation.
Great, thanks, Zach. And depending on where you are, good morning, good afternoon to everybody. Thanks again for having us here. It's a real pleasure to be with everybody. So I guess to begin, the title of the presentation revolves around maintaining control. And I think one thing to kind of level set for everyone is, if you have a business and you want to maintain absolute control over every decision, you probably shouldn't take capital from outside sources. Even for most people who are familiar with, even your bank and your loan documents are going to have certain covenants, information rights, special approval rights, and those types of things. So even in a traditional banking situation, you don't actually have absolute control. And when you're taking on equity, a lot of the control mechanisms in equity documents will look very similar to some of those structured finance documents, but there's some definitive nuances and differences. And we're going to touch on a lot of that during this presentation. But we just want to kind of set the expectation that maintaining absolute unfettered control over a company while taking on third-party investment is probably not realistic. But there are absolutely things you can do and ways that you can negotiate the control over the business so that you can take on capital and you can maintain control over most things, and you can negotiate a lot of those things for which you'd want to make a decision, and you need to involve your new private equity or whomever partner in the business. There's a variety of ways to negotiate those control rights, and we'll touch on some of that here. We also wanted to touch on from the beginning. We had some pre-presentation questions that were sent our way. One of them involved the raising of debt and various types of debt, mezzanine debt, convertible debt versus equity. That's probably a presentation unto itself. The way your capital stack might actually look when you factor in all the private capital you've taken, whether it's debt or equity capital. We are going to focus this presentation on taking on equity capital. You would see in most of these transactions, there will absolutely be a debt portion too. Almost certainly a senior lender will be involved. Many times there'll be a mezzanine lender, so a subordinated lender who will be involved as well. And then you can get really artsy and have different types of warrants and different types of equity and equity-like rights that kick in into the overall structure. But for the purpose of today, we'll talk about private equity type investment and really and to Zach's point, and we'll touch on this a little bit more, what we've seen as a blending of the equity markets, these private capital markets, where venture capital firms have moved maybe upstream, where private equity firms certainly have moved, I wouldn't call it downstream, but they've gone into traditional markets and investment patterns that were not really the way that traditional private equity funds had originally started to invest. So they've gotten to be a bit more flexible in their models, and frankly, we're seeing some private equity firms who are playing in a space that no one or not many really played before. So looking at this next slide, many folks might know the traditional private equity structure. A fund is formed. There's a sponsor or the general partner or a group of individuals who form the fund. And that's the investment team. They raise capital from limited partners, usually institutional investors, family offices, high net worth individuals, pension funds, banks, insurance companies, all those types. So they raise their fund with a mission of deploying that capital into investments in private companies, pre-IPO companies. Those almost always, they're clearly revenue generating. And then there's a smattering of equity firms who play at different spheres in terms of, the EBITDA multiples of those companies or market share. Some private equity funds are market specific or industry specific. Some will play in multiple verticals, industry verticals. So they have every kind of investment thesis. You can have every kind of investment thesis that you think of. There's probably a private equity firm out there that fits it. They usually will go and acquire a company, usually a larger size company, and use that as what they call a platform company, and then do a variety of what they also call bolt-on acquisitions to grow that company in its industry. At some point, though, that fund, being an investment instrument for its limited partners, it has a sunset, and those funds will have a wind-up period. It's usually staggered, but generally the funds only exist for about 5 on the short end and 10 on the long end, kind of 7-8 years being the middle of the pack where they go. So an investor will make their investment and expect to be returned their investment plus a return on their investment within that investment horizon. Typically and historically, private equity would acquire controlling interest in companies. And sometimes that controlling interest was 100%. There was an absolute 100% acquisition. Many times, and certainly over the years, it has evolved where they will purchase control positions, but allow current ownership to what they call roll over or maintain a minority piece of the business. Usually stay on in as management or in some management capacity, and work with the private equity fund. And the real beauty in that for most investors is that you take most owners is that you take a lot of your chips off the table. You have a large kind of liquidity event for yourself. You stay in the deal for a small piece of the deal. You can continue to run the business or transition it to new management teams. And then at some point, 3, 5, 7 years later, you'll have another liquidity event. You'll have a smaller piece of the business, but by then the thesis is that it will have grown so that you'll kind of get a second bite at the apple, and overall it's a better overall return for the owners. So that's the typical structure. Zach, if we can jump to the next slide.
Hey, and Joe, real quick, Dave had a question, and I felt like this would be a good point for him to chime in about kind of a different hybrid structure. Dave, you want to ask your question?
Yeah, absolutely. Can you guys hear me okay?
Yeah.
Thanks.
We can, yeah.
Awesome. So I have a C Corp. It's a startup. I'm with High Country Air Service, and I'm trying to fundraise at the moment. However, I can't, in order to preserve my veteran-owned status of my company, which later on enables government contract set-asides, I need to maintain 51% veteran ownership. And in this case, right now, that's me because I'm the military veteran. So I can't take too much dilution, at least certainly not. I can't sell a controlling interest to a private equity firm, but I am interested in raising private capital. And so I wanted to ask about the possibility of using disproportionate dividends to kind of thread that needle. So what I mean by that is, say I sell a minority position ownership interest to the private investors, but I would pay them dividends that are a percentage of the profits that is in excess of their ownership position in the company. And I'm just curious if you guys have seen that, or if you could comment on that as a strategy to minimize my own ownership dilution while maximizing the rate of recoupment of the private equity investors' investment.
Yeah. I mean, so great question and a great segue into the presentation, Dave. So thank you very much for that. So look, most of your private capital transactions are going to be raised through preferred stock. And you're a C Corp, so you'd be a classic example of this. if for anyone out there who has an LLC, you can achieve the same result. It's just using different nomenclature and it's different tax rules, but you can get to the same spot. You typically offer your investors preferred capital, which means a couple things. At its core, it certainly means if the company is ever liquidated, they're going to get their money back before the common stockholders get their money back. But in addition, for preferred stock, you can give them dividends. You can give them special dividends. Usually they're fixed rate dividends. So it is a certain stated percentage of their investment year over year. Those dividend, and from there you have a lot of fun. You can, deals go all over the place. Sometimes dividends accrue and are only paid upon a liquidity event. Sometimes dividends are paid currently. Sometimes dividends are paid currently only to the extent the company has cash to do it, and then they're curtailed or pushed into a future year if the company can't actually make the dividend. So Dave, in your case, being a C Corp, you have a little bit less flexibility than you do as an LLC, but there absolutely would be a way to set up preferred stock to achieve a return for those investors that is disproportionate to their ownership. And frankly, that is exactly the concept of almost every private equity deal, where there is some ability for the investor to have an outsized return, even though they may have less in terms of ownership percentage. And certainly in these minority investment deals, like the ones that we are talking about today, the ones that we are seeing increasing in the marketplace, someone may come in for only 20% of the company, as an example, but they're going to have a liquidation preference or a dividend rate or a combination of the two that give them the opportunity to hit a home run, even though they only have a 20% stake in the business. So again, thanks for the question, and hopefully I answered that well enough, and it's a great segue into this slide.
That's fantastic. I appreciate that. One quick follow-up. Have you seen in these kinds of deals for private equity and minority investment where the disproportionate dividend is complemented with some non-monetary benefits? So for example, my company is expanding into the air charter industry. So we're going to start flying people around. And one of the concepts I'm exploring is perhaps offering the seed stage investors heavily discounted rates on our company's services.
Yep. Oh yeah. And that's really simple, Dave, because so people do all kinds of, yes, there's all kinds of added benefits that are not just tied to stock ownership. Right. There's a big thing in the private equity world called side letters, where folks will have, not only do they have different rights sometimes with respect to other investors in the investment, but they get special add-on benefits. Sometimes it's just board observation rights, something like that. Sometimes it's they get a special fee. Sometimes they get things like you're talking about, discounts on services from the company. Frankly, everything's on the table in most of these deals, and it wouldn't be atypical at all to have a deal that you would structure where there'd be something like that in it.
Okay, hey, fantastic. Thank you.
I don't want to steal from your presentation, Joe, but I think it's real timely. Dave, we have our investment group, Beachhead, here that invests in military-backed companies, and to maintain the disabled veteran status that we've done it through convertible debt.
Gotcha.
So everyone's real happy with that, right?
Yeah,
so
that's an awesome
returns. You get paid back. It's interest instead of a dividend. It gets paid back, and you convert it at a specific time. So it's worked out perfect.
Okay, great, thank you.
And then there's some contractual, protections in there for the investors. So.
Yep. Yeah, that's a great technique and tool. Convertible debt can solve lots of things. Just want to make sure you structure it such that the IRS or whomever is evaluating it doesn't say that convertible debt looks so much like equity that they're going to try to deem it as equity. I know the IRS has done that a number of times.
Yeah, there's an attorney
I know the SBA and others sometimes do that too.
Yeah, there's an attorney here in Houston that actually specializes in that. So.
Yep. Oh, yep. That's great.
And
so,
to Dave's point, just sort of as an overarching point, I think as a general matter with respect to this presentation and the issues that we're talking about, Dave, I think it's important at the outset when you're out fundraising and you're talking to potential investors, whether it's convertible debt, whether it's mezz debt, whether it's equity, with the preferred return, I think that the idea here is trying to find a good partner and a good strategic fit for you. And trying to find, a partner that's going to be aligned with your objectives. And, in your situation where you're trying to maintain your VAT status of, you have to maintain 51% ownership, convertible debt may make more sense. But again, I think it is sitting down at the outset of your fundraising and really trying to map out, what your strategic priorities are with your potential investors.
That's great, fellas. Those are some excellent commentary. It's certainly worth the price of admission today. Thank you.
Great.
Good.
Great. Well, thanks for the question. So one of the things that I was mentioning is, originally private equity came in and did control acquisitions. They would only buy control and allow owners to roll over for a small piece. We have seen and had very direct and very recent experience moving kind of down the line where, and we actually have a number of private equity firms we work with here locally who are not interested in a control position. They are actually interested in doing minority investments. And what they bring to the table, obviously, is some cash component. So there is certainly something of a liquidity event for the current owners. But oftentimes it's used best when those owners are interested in growth capital. So they want to partner with somebody who's going to bring not just cash to the table, but they're going to bring financial expertise, M&A expertise, access to potential members of a board of directors who will help the company grow. But they're really looking to take their own company to the next step. They don't really know how to do it, and they want to partner with someone who can be a value add partner to do that with them. And we've seen this happen really successfully. And frankly, and on this slide, you'll see here at the bottom, there has been a significant increase in the amount of private equity transactions that are occurring for minority investments in entities. So not control buys, but taking minority positions. And so folks like me who do this all the time, we say, well, God, there's forever been a market for that. It's called venture capital. They come in, they buy minority pieces of companies, and they set investment structures and investment terms that give them minority ownership protection. And that's a big spectrum of what that protection looks like. Sometimes it's you might look at it and go, wow, they just basically took control of the company with a 20% investment. And but in a better negotiated situation, you'd see that there's a balance of power between that minority investor and current ownership. But there has been a real uptick in private equity moving down. And maybe, Zach, we can skip past a couple slides to the growth equity slide to show everybody what we're talking about. But we set this slide up so you can see the kind of life cycle of a company from inception, to what we always call IPO, when it's owned by the public markets. So in the startup phase, you have the 3 F's: friends, family, and the third F is either founders, fools. They got all kinds of acronyms, but the 3 F's, that early stage capital. After that, you have angel investors, so high net worth individuals who are writing bigger checks. Then you get into the venture capital world, where these minority investments have been going on, like I said, and that's what they've been doing for decades. And then private equity there used to be this donut hole. There was venture on the lower end, and then private equity came in after the companies were, revenue positive, EBITDA multiples were looking good, beautiful, up and to the right, compounded annual growth rates. And then private equity would come in at some point then. And there was a bit of a gap between the venture side and the private equity side. And over the years, the venture capitalists have come in and done, everyone hears of a Series A round, and, they commonly will move up and do a Series C and a Series D round. So we're talking, later stage and large dollars. Anyone who's watched the news about how any of the unicorn companies have come through. Some of these rounds are hundreds of millions of, or even billions of dollars. The private equity guys usually stayed away from all of that, and they stayed, again, at these control buys, but now they've kind of slid down cycle where they're doing these minority investments. And so where we're seeing a lot of things happening is this intersection of what we're calling this circle here on the slide, growth equity territory, where you're looking for growth capital and you're seeing maybe your company isn't right for venture capital. You're not a technology-based business. You may be more of an asset-heavy business where you can leverage your balance sheet. It's not really a venture capital model. And you're seeing now the private equity guys slide down and be willing to come into those types of companies at earlier stages than they ever were, frankly. And the reason is there's a whole bunch of reasons. I think first of all, there's many more private equity funds than there ever were. There always seems to be a new one starting up. And so they're chasing after the best investments. There's a lot of dry powder out there. They have a lot of capital ready to deploy, and they need to find places to deploy it. And oftentimes, even in an equity fund that has a primary strategy of doing control buys, they may have the ability to have a bit of an asset allocation, what they might call alternative investments, into minorities. They may be able to, kind of hive off a sliver of their portfolio and do minority buys there, just to be able to deploy capital, because that's their real mission. So we're seeing a lot happening here. I think at this point we should probably jump a couple slides so we can start talking about what these investments really start to look like, and what are the structures of them and the terms that most owners are interested in understanding and then negotiating.
Great. So as Joe mentioned, so now we're gonna take a look a little bit with a little bit more finer lens in terms of what PE firms are going to be looking for when they're structuring and negotiating a transaction. Most importantly, PE firms are going to be looking for structures that require a few certain objectives. They're going to want a high return on their invested capital, and they're also going to be looking to minimize the downside. So that's part of the reason that you're going to see some of these structures, some of these mechanisms put in place, because they are looking to minimize risk, especially because they're looking at a long-term investment with an illiquid security. There's no readily available buyers if they find that they're not happy with the investment. So they are going to ask often for a high return. They're going to look for liquidation preference. So when you do finally go and sell the company, they're going to ask for some kind of preferred return when you do liquidate and sell. They're often going to want to have some sort of oversight over management, whether that's respect to seats on the board of directors, or control over key executive and personnel hiring decisions. They may ask for oversight over financial matters, in terms of control of your books and access to your books and records. They're going to look to incentivize your existing management. Often PE investors are going to want to help you set up, a management incentive pool, whether it's through stock options or profits interests, which is going to bring some further dilution to your interests. So even though you're in this situation or the context that we're talking about here, which is a minority PE investment, they are often going to want to see a structure where you're going to be diluted a little bit further when you start issuing stock options to maintain your key employees. And then finally, they're going to want to have key decision-making power over change of control, sale of the company, or your exit, and what that looks like. So, I think this last bullet point is really meant to highlight, this is sort of what, from a general perspective, what they're going to ask for, what they're going to insist on. And you should understand that at the outset, this is your negotiating arena. These are the items that they're going to insist on when they come to the table with their capital. And so it's really important at the outset, with your lawyers, with your bankers, with your financial professionals, to really articulate and really drill down. I was mentioning this to Dave earlier, is to really drill down on what are your priorities. Is your priority to maintain, management control over the company? Maybe you don't have, a ton of financial expertise, and that's something that, is an easy give to sort of hand over to your new, investor partner. Do you want ultimate decision-making authority over your key management personnel? And really being able to frame out and articulate, what it is that is your, what your priorities are at the outset of your engagement with your investor, can really help shape the dynamic and can really help you find the right partner. If you're interviewing a few potential investors, having that roadmap and having the menu of things that are important to you at the outset can make a huge difference throughout the negotiation. So then taking that last side and just drilling down a little bit further, again, I mentioned on the last slide, investors in the PE world, they're looking for a high return on their invested capital while also trying to minimize the downside. And the way that they do this is often through convertible preferred stock, where they'll get a preferred stock instrument that's typically at some point in time, whether it's on an exit or a liquidation, they're going to look to convert that into common stock. In the meantime, they're going to be looking for some kind of preferred return or dividend to help them give, a fixed or a high side return on their invested capital. They are going to be asking for anti-dilution protections. If you want to bring in more capital, if you want to bring in a new partner, if you want to do rollover equity, as part of a future funded, bolt-on acquisition, they're going to ask to have, contractual protections in place, either through your stockholders agreement or through your operating agreement if you're an LLC, that really spells out, if someone comes in and brings in new capital and they're getting X percentage, then the investor gets to maintain their same economic percentage in the company. Preemptive rights, same thing. It sort of dovetails along with anti-dilution. If new equity or if new securities are being issued in the company, the PE investor is going to want the ability to participate and have the right to buy their pro rata share of any sort of security issuance at the time that that's done. And then finally, redemption rights. Typically, what you see is an investor is going to say, well, under a few different circumstances, they want the right to put their interest back to the company. So they're going to insist on a put right that will require the company to buy back their equity. Typically, you'll see that they'll have a fixed contractual date. Maybe it's 5 years, 7 years from the initial investment, where if you haven't sold the company or they don't like the way it's performing, frankly, if it's just an arbitrary date that's set in your agreement, for any reason at all, they can put their interest back to the company and force the company to buy back their interests. You'll also see redemption rights in the context of certain performance metrics. Whether it's if you've got other senior debt in the company, or you've got other financial metrics of the company, where if you don't achieve certain metrics for 4 quarters in a row, they can put their interest back to the company. It often really creates an interesting tension, because redemption rights can create a really interesting tension, because obviously, if the investment's doing well, then they're not going to want to exercise their redemption right, and they're going to want to stay in. But maybe at that point, the company, you as the majority owner, you want them to exercise their redemption right. So that may be, if you really are betting in your company, maybe you want to insist on a counteractive call right, where you get a call right to buy back their interest after a certain date. And then the alternative is the other side of that tension is if the investment's not doing well and they've got this redemption, they've got this put right, and the company's not doing well and doesn't have any money, then the fund is often then the fund's going to be left hanging high and dry in that situation. And then the other thing that we often see is with respect to redemption rights, is you see funds who want to be able to roll, that funds often have a sunset, 5, 7, 10 years on the life cycle of their fund. So they want to be able to distribute the equity of the company out to their limited partners, or to otherwise roll over their equity into their next fund. So that's another key part where you'll see investors who want to negotiate the circumstances in which they can push out the equity to their limited partners. But again, generally just very broad set of contractual rights that they're gonna want to negotiate in this sphere with respect to economic protections. The other big area, as I mentioned, that they're gonna want to drill down on and that they're gonna negotiate hard on is their oversight of the portfolio company and any sort of other operating subsidiaries. They're gonna probably want representation on your board of directors, or at least some sort of board observation role. They're going to insist on what are called negative controls or negative covenants. It's going to be a laundry list of 12, 24 sets of actions that you as the owner, even though you're a majority owner and you otherwise control the voting securities of the company, you won't be able to take those actions without the affirmative consent of your minority investor. So, we've seen investors come in and want to, want to control key hiring decisions of your key personnel and your executives, and will ask for a negative control right in order to hire any employee or executive employee making in excess of $150,000. That's the type of, and even though they only have a 20%, a negative control right would give them the ability to block that action or require their consent to do that. They're going to want, obviously, information rights. They want access to the books and records of the company. When we've got even minority PE investors, when they show up at the board meeting, they are going to grill the company on all the financial metrics. Maybe they'll take a little bit more passive approach to, BD and some of the other aspects of the company, but they're going to drill down very hard on your financial metrics. And I gave a little bit of a discussion earlier about, how they're the PE firms wanting to make sure that management is incentivized to stay and to continue performing. And then the last area that I mentioned is the control over the liquidity event. They're going to want to be able to approve a change of control or a sale of the company, period, full stop. That's probably one area where you are going to see the least room for negotiation, because if they're going to experience a liquidity event and they're going to have to deliver, certain returns to their investors, and they have to turn around and they have to answer to their LPs, one of the biggest ways that that's going to happen is on an exit. So they are going to, this is probably one of the areas where you'll have the least ability to negotiate. But that being said, the counter to that is if you're in a mature company and you're looking for a partner, what better partner to have than a private equity partner who's used to doing transactions, who has expertise in doing transactions and has the resources to go out into the field to help you negotiate your sale, to help you find potential buyers, to work with the investment bankers. I mean, these are effectively acquisition M&A experts. So thinking about that from a from the sunny side of the street is, although that they're going to want to control over the sale, that's probably one of the most important reasons to bring on a strategic investor, strategic partner, and it's also going to be one of the biggest value adds. Some of the other things that they're going to want to control over is limiting transfers. So if they're taking a minority position, odds are they're investing in you. They're investing in the existing management and the existing ownership that's gotten you to where you are today. So they want to make sure that you're not selling down either without their ability to go along for the ride. So that's a tag along right, that if you as the majority owner say, you know what, thank you, private equity partner, for bringing this capital to the table. But I want to take my 60% and I want to get out. I've rode this as long as I can. The private equity partner is going to insist on a tag right to participate in that transaction and sell along with you, and force the buyer to bring them along. Not an unreasonable ask in that circumstance, again, given the fact that they like your platform, they like your business, but oftentimes if it's a minority investment, it's because they're really betting on the existing ownership and management. We already spent a good time on redemption rights, so I'll skip that. You will see sometimes that even in a minority position, you'll see private equity firms insist on a drag right, which is maybe they don't like the status of the investment. Maybe they're looking to get out. Maybe they think that it's time for a sale, that you've maximized value, so they want to sell their interest. And a drag right, it would be a contractual provision that would allow them, even though they're in a minority position, to drag along the majority sellers along with them. And the counter is that you, as the majority owner, will also want to insist on a drag right, where if you as the majority owner want to sell, that you're also able to drag the minority PE firm. So you see it both ways. Obviously, the first one you see a little bit less, the latter a lot more frequently, but nevertheless, drag rights, it's an important fallback if the investment is dragging out, for lack of a better term, for dragging along a little bit longer than folks expected. And then the last is registration rights, particularly for mature companies. If they're getting to the point where they've taken the private equity capital and you've continued along your growth, and you see a potential exit horizon, and instead of wanting to sell, you say, I want to take my company public. Registration rights, the PE firm is going to want priorities in terms of the ability to participate in the IPO. So, now that we've spoken about some of the things that, private equity firms or other growth capital investors are going to look for and insist on, and the field of play that's kind of that's up for negotiation. We're now going to look at it from the lens of, and we've touched on some of these issues, but now we're going to look a little bit from the perspective of you as management, or as the majority owner. How do we put in place these certain protections to make sure that you get what you want out of the investment? And again, we've mentioned it a few times, but the important part here is you're not going to win on all of these. You're not going to get all of these points. And as Joe said at the outset, you are not going to maintain absolute control. You're just not going to get someone who's bringing millions of dollars to the table and going to want to just sit back and hang out passively for the next 5 years. Instead, you should think of these as a menu of potential deal points that, again, you want to articulate and prioritize at the outset of the potential engagement to make sure that, if two of these are really important to you, those are your 2 deal points. Those are the ones that need to carry the day, and maybe makes it easier to give on some of the other ones.
Yep. Yeah, thanks, Zach. I mean, I think just so we don't get accused of false advertising, I'm sure folks are saying, wait, we talked about, you just mentioned all these things that they're going to insist upon, and I feel like I won't have any control in all of that. So to Zach's point, every one of those issues we touch on are certainly that he just touched on are certainly ones that the private equity firms will put in their documents. There are negotiable aspects of each and every one of those, but by and large, many of those end up falling at least to the benefit of the private equity fund, because they're putting in the cash to do the deal. So let's talk about the stuff that management teams and owners really do fight with, and where fight to keep control over, and where there is room for negotiation over a lot of the day-to-day management things that frankly are the things that matter the most to many management teams. So we've talked about dilution protection. So we've said that the private equity firm will come in, especially on a minority buy, and they'll want to have dilution protection. So they'll want to be able to purchase additional equity to maintain their ownership over a period of time, or maybe have their ownership adjusted if certain events were to happen. That can also be said to be true for management teams and ownership groups, where ownership groups may want very similar types of dilution protection, so that if there is a subsequent equity capital raise, maybe maybe the current owners or the management team want the ability to buy into that at a certain rate, or to maintain a certain ownership percentage. But that dilution protection can go both ways. Sometimes with management teams, we solve it using stock options or some other type of convertible or equity-like instrument. But many times the idea of dilution and who will own what percentage of the business falls to both sides of the table. And it's a conversation that both sides have, and we see that occur. We see dilution protection occur for both parties at the table. Control over management. So this is usually one of the biggest things. I think most folks who are taking on additional capital, most folks realize that when it comes to big ticket items, they're frankly going to need to go and have approval from their equity partner. And most people get comfortable with that. Where they start to become uneasy is when we're talking about ordinary management rights. What color are we going to paint the bathroom? Are we going to do an add-on to the facility? What if I want to hire a new officer of the company? Who has to approve that? Under what circumstances? And so there's actually a ton of negotiation that goes on around day-to-day operational control matters. As a current owner or as a management team, obviously you want that list of control rights to be very small, so that most control rights fall within the purview of the executives of the business. If you are an owner and you do a private equity deal where you find yourself in the minority, so maybe you sell a controlling interest in your business, you might flip the script on them, and you might ask for certain of these approval rights over certain things a private equity fund might do. But certainly there's a lot of negotiation around management control rights. Who gets to be on the board? Is it controlled by the private equity firm? Is it controlled by current ownership? Is there an independent director or a couple of independent directors that need to be on the board as the tiebreakers? So those are all areas where there is a ton of negotiation that occurs, and there's a lot of flexibility, frankly, in ownership groups to really mold the deal in the way that they're willing to do the deal. We also talk about amendments to charters and bylaws and operating agreements. So the governing documents of the business, certainly those from both sides will never be able to be amended or changed after closing without the other side agreeing to it. But that is one place where you can rest assured as an ownership or management team that once you strike the deal will not change on you, and your counsel should be setting up the deal documents so that none of those documents can be altered or changed without your consent to that. And we've already touched on the investor special voting rights, but there's usually a laundry list of voting rights that your outside investors they will have. Many times we'll marry those rights up with the rights of the controlling stockholders. So we might say an action can't occur unless there is the affirmative vote of the investor, the private equity investor. And if the current ownership group is a large group of people, you might say, well, it requires the consent of the private equity investor, but it also requires the consent of either a majority or a supermajority of the existing owners, so that it's a double trigger approval right. And we do that a lot. That's found in a lot of deals. And that's one area where current management can, again, make sure that they're not allowing private equity into the company, and then somehow there is this adverse consequence where they have somehow lost control over voting rights. So Zach, maybe you want to bounce to the next slide.
Yeah. And so so I think I touched on this earlier, but one of the biggest protections that you can, or frankly one of the biggest value adds that you get with a minority investor is in the financial matters arena. you can ask, as part of the negotiation, your investor may be willing to help you with your books and with your records. But more importantly, they're going to want to participate very heavily in just a general oversight into your financial matters. And it's something that, quite frankly, out of anything, that should generally be pretty welcome to you as the owner or management, just given the level of expertise. And we're talking about a lot of MBAs, CPA types who have worked in investment banks, who have worked for some of the biggest financial advisors around, and so it's an immediate value add is in the financial space. Another area that you can really assert control is over key changes in the business. If you want to maintain control, making sure that before the company pivots to any sort of new direction or taking on new personnel, that you have oversight and control over that. Affiliate party transactions, maybe you have an affiliate that's set up to provide more management oversight and management fees, or quite frankly, on the flip side, the private equity firm may have a management team where they want to engage to provide outside services, and you may want to be able to control that to make sure that they're not just whether you want it or not, controlling outsourcing of key functions and administrative functions to a third party that's a related party to your investor. Acquisitions, again, this is an area where private equity firms and other financial investors or sponsors are going to really be able to bring you an immediate value add. They have the expert. They are professional M&A businesses. They're going to have access to resources, and more importantly, they're going to be able to contribute more capital in order to help you fund acquisitions without having to go into your traditional debt markets. They'll bring in, say they've already made a 30% investment in your business for $8 million, but you think with your partner that it's time to grow the company, and you find a good strategic acquisition, a bolt-on acquisition that you want to fund for $2 million. Well, you have your access to capital already. You've been working with your strategic partner, your investor, for several years now. That capital's, and as Joe mentioned, there's a lot of dry powder out there. I mean, I understand that as of July 2020, there's somewhere around $1.7 trillion of private equity dry powder. So they're also looking to grow your business and help you achieve the highest valuation that you possibly can. And so they're interested in helping you fund acquisitions. So they'll be able to not only bring the capital to the table, but they'll also be able to bring on that acquisition expertise. Importantly, however, if they're going to bring that additional capital to the table, it's another area for negotiation. But if they're investing another $2 million in my hypothetical, well, you're going to get further diluted. Their interests are going to go up. So, as we talked about with anti-dilution protections, that it's going to be a challenge, but certainly, if they're bringing another $2 million to the table, then you're going to see yourself diluted. They're going to see their position increase. And then finally, we discussed this earlier, but the sale of the company, same thing with the acquisitions. What better partner to have than a private equity partner who's professional. They're professional deal makers to help you and guide you, help you negotiate all the way through the exit process. Okay.
So now we thought we touch on some key takeaways for folks, because we want to be sensitive to time, and we want to open it up to any other additional questions. But one of the biggest key takeaway from this, we hope, is as you're thinking about growth capital, give some thought to where you are in your own company's life cycle, and who is the likely best partner and strategic fit for you at that time. You may be closer to an exit strategy, or you may be on more the startup side, and you have to pick which partner is going to be the best suited for you during that time. There used to be very if you walk away with kind of with one impression from this, I would hope it's that you see that the markets are not static, they are very fluid, and that there are all kinds of private capital investors out there willing to put money in at different spots. And there have been some very traditional lines, and all those traditional lines between the investors have, quite frankly, been certainly blurred, if not completely obliterated as of late. So give some thought to that, and hopefully you have a team of advisors around you who can help you in the analysis to determine where you think you are and who you think the right folks might be. That really leads to a strategic fit, and that's a cultural fit. It's a management fit. You really need to do some due diligence on whoever your growth capital partner is going to be. And I say this becomes a partnership. It becomes a bit like a marriage. And you really need to do some due diligence there, because while your company is doing great, there probably is not going to be very much friction. But you really, when you're picking partners, need to make sure that you have a good understanding of how they react in times that aren't so good. The best success stories we've seen are with private capital partners who are a bit more patient. Hopefully some or many of them have had management experience or operated a company themselves, that they're not all more advisory type folks. They actually had to hire and fire people. They actually had to make really hard business decisions. And, so that when you are in the foxhole in the middle of the battle, that person next to you is really important. And if they've been there before, or you have a high degree of confidence that they're not going to lose their cool in that situation, that's almost always going to be a better partner. And figuring that out can sometimes be hard, but certainly you should do your due diligence to find out what their background is and how they've done and managed through crises inside their own portfolio. So that strategic fit with that partner is really important. And then negotiate. Many people will tend to think that that this is all rote and that there's a fixed set of deal terms, and you can only you have to take whatever you're given. You have to take the money you're given. You have to take the terms that come with the money. And we're here to say that our job is to negotiate, and we negotiate these things all the time, and everything's negotiable. There are some things that certainly more generally fall one way than the other, but we've done all kinds of deals where any of these terms that we say, oh, that private equity firm is going to insist on that. We've done deals that didn't even have that term. So everything's negotiable, and pick a good team around you who can help you navigate those negotiations, and make sure that while you will certainly have to give up some control, you can hone in on the things that you care about, and you can strike the right deal and the right balance for the control that you want and need.
Great. And again, I think this is just touching on what Joe was just talking about finding the right strategic partner. One thing we didn't talk as much about, but bringing on a private equity minority investors, and also an opportunity to bring some near-term liquidity for your existing shareholders. You get to take some chips off the table, put some money in your pockets as well, and then also just think of it as also an alternative financing option. That's it.
Awesome. Well, thanks, guys. Thanks, Zach. Thanks, Joe. Guys, if you have any more questions, looks like we actually do have a few coming through. Dave, you were asking about opportunity zone investments, and kind of what's hot in that space. And let's see, is there any private equity firms doing opportunity zone investments and or SEC 1202 investments? I'm not sure of which firms. I know a good buddy of mine works at Flagship Capital Partners. They do quite a bit in opportunity zones. And just you would have to check and make sure what their time horizon is to make sure they're getting all of the advantages of step up in basis and tax deferrals. As far as who that is, I couldn't tell you. Maybe these guys could. Anything around opportunity zone investments, Al, or even Zach?
Yeah, I'll jump out there. And Andrew, we've got a number of partners who are helping people form all kinds of opportunity opportunity zone funds when the legislation first passed? The answer is yes. There definitely are funds. They seem to be geographically oriented, but there are absolutely funds that are out there, and we can take a look and see a list of the contacts that we have. But there are definitely folks out there who are specifically investing in opportunity zones. Although I think maybe there was a big push for that. I think.
See, did your mic cut out?
And I think Joe just froze up a little bit right there at the end.
That's fine. No worries. Another question was, have we seen private equity at earlier stages? I think we kind of touched on that earlier. I guess really the defining factor is it going to be pre-revenue? Does it have a minimal viable product? And if not, then it's probably more of a venture-based investment, really early stage. But growth equity would be my answer to that, where it really bridges the gap between a venture capital-esque investment and a traditional private equity investment. And that's about as early, I think, early stages it would go.
Yeah.
And then let's see, what is your opinion on negotiating phase out equity for partners? From Kristen.
So if I understand the question right, I think that means a staged buyout over time.
Yeah, Chris,
always
that just unmuted
challenging?
your mic.
Yes,
if you'd like
yes,
to.
that's exactly what I mean.
Oh, great. Thanks, Kristen. So they're challenging because you usually set up a plan for that staged buyout, but a lot of stuff happens between the time that you set the plan in place and then before the partner is ultimately bought out. And so trying to solve for those contingencies of what happens if the buyout stops because the company doesn't have money for it. Is the exiting partner able to kind of step back in and take control, or do they have collateral for that buyout obligation? So my view on them is they can be, we do them all the time. There's a lot to be said and done about setting them up, trying to set them up correctly and trying to cover all of the bases. But they tend to be, I'm in the middle of renegotiating one right now because, as an example, COVID happened. And so none of the stuff that was expected to happen in terms of revenue happened. And so the buyout obligation has become now too expensive for the company to be able to afford. And we have to go back to the partner and renegotiate. So the big lesson learned on our end from maybe we need to put a force majeure clause in every single buyout provision that we have going forward. But structured and phased buyouts are really, really helpful tools. But there are some hurdles and speed bumps in the way sometimes that we have to be able to navigate effectively.
Awesome. And then, hey, Dave had another question about, it's kind of around kicking off this whole process with a private equity investor. Do you use the private placement memorandum as the opening bid, if you will, for kicking off negotiations?
Yeah, well, certainly it kicks off negotiations. Those PPMs, so on the startup side of the world, the PPMs usually actually contain the offering terms. So they're setting the preferred stock, they're setting the dividend rate, they're doing all of that stuff. And so in that case, yes. Now, if you're moving out of the venture capital world or the startup world into private equity funds, often you're not putting any terms of the investment into the PPM. You are just saying you're taking it, and really it's not called a PPM at that point. It's more like a information memorandum that you're circulating saying we're looking to take on investment. Come talk to us and we'll put your terms forward, almost like a bank would put together a term sheet for you. You private equity firm, give us your terms for investment and we'll negotiate from there. So it depends on how you use that document and what point you are in your life stage, but certainly it is the first, most of the cases, it is the first point of negotiation.
Awesome. Well, I know we're a few minutes over the hour, so I will go ahead and wrap things up. But I mean, Zach, Joe, great presentation today. Really robust. I know we've got a lot covered today and probably a lot more we could cover in the future, and hopefully we'll get you back.
Yeah. Thanks for having us, Andrew. Thanks for having us, Gary, Al, Casey, and Exit Advisors team. Obviously, as Andrew mentioned, covered a lot of ground here, but, feel free to give us a call. We're always happy to chat. I think above all, Joe and I like to place ourselves as just a member of the team when thinking through and talking about these issues. So, always willing to just chat about whatever it is on your mind. And, if it's related to this, great. If it's anything else, you'll see in our presentation, we've got, we're a full service firm. So happy to field and address any issues you guys may have.
Yeah, I definitely encourage everyone to reach out. I think you've got your contact information in the end of these slides. And as always, we will email out the presentation and the recording, and it'll be posted on our website. So we encourage you to keep reaching out to all of us. And next week, this is actually going to wrap up the year. We've got 3 more left for the year, and then we're going to take a break. We're actually taking a break next week for Thanksgiving. But year-end moves, smart year-end moves is going to be with Joshua Ritchie, just kind of going over some housekeeping items that businesses can do to really, get their books closed and get ready. Mid-December, we've got investing in real estate. That's going to be with Chris Holtz. And finally, George Joseph, who we've actually had before on one of our panel series. He's the CEO and owner of the Common Bond Bakery, really popular spot here in Houston. So we encourage you to come out to all of these, and thank you all for joining us. Thank you, Zach and Joe, and look forward to having everyone here again in a few weeks.
Thank you, guys.
Great. Thanks again.
Take care.
Yep. Take care.